Welcome to Tuesday Afternoon Networking. My name is Coco T.A.N. I'm a realtor with Keller Realty in the San Francisco Bay Area. I love connecting with all of you in the form of T.A.N seminars. To stay up to date on what's new in the world of Coco T.A.N real estate, be sure to connect with me on WeChat, sign up for my emails, and subscribe to me on YouTube. The QR codes are right behind me. You can scan them with any smartphone camera. So go ahead, try it. Hey, did you all know that June 1st is Flip a Coin Day? All over the world today, people are flipping a coin to make a decision. This practice was introduced by Roman Emperor Julius Caesar, who put his head on the head side of a coin. The magic of flipping a coin can be used to make a decision in seconds, as long as there are only two options. Should I make dumplings or noodles? Should I wear the blue and black dress or the white and gold one? Is now the right time to put my house on the market? So one thing a coin cannot do is to give tax advice. And I know you are all here to learn about the recent changes to the California state local property tax laws. As you may already know, the passage of Proposition 19 has improved tax base transfer for older Californians, but it also set a tax trap, increasing the property taxes for children's inheritances. And what about the changes on the federal side? Will there be any increases or exemption changes? Can anyone out there predict the future? Well, maybe. For this second quarter update on taxation, today we're very honored to be joined by Mr. Michael Lee of RE Attorneys, who is also a professor at Santa Clara University Law School. You may remember him from the past seminars about asset protection, estate planning, California Proposition 19, and Proposition 19 Revisited. Hello, Michael. How are you?
Greetings, Coco. Thank you very much for inviting me. I'm always glad to be back.
That's wonderful. Your talks about Proposition 19 left a deep impression on many of our viewers. They're wondering what else you can share with them at this moment.
Well, great. Actually, I think I have your segue of Flip a Coin Day is really appropriate for what I'm going to talk about, because today, actually, I'm going to be doing a lot of guessing today and a lot of making some predictions, which I'll tell you is maybe only as good as a coin flip, because what we'll start out with, and actually here I'll just slide over with the screen here, is we'll be talking about changes in the federal, state, and local tax law. And there are some unusual things happening, and it is a little bit difficult for me to predict. So as we discussed last year and then earlier this year with Proposition 19, we had the arrival of Proposition 19. Of course, there was a lot of lively planning in December, January, and February of this year. And then Proposition 19 has settled somewhat. And we'll talk about that a little bit at the end of this lecture. And one of the things that I kept mentioning throughout the earlier part of this year, and to a large extent last year, was we were talking a lot about estate tax changes. There'd be changes in the estate tax law, and of course, lo and behold, we end up with the proposal, the American Families Act, by the Biden administration, and the American Families Act does not look like anything that I was predicting. It doesn't actually look like anything that anyone was predicting. So, of course, we know who we are. This is Shaway and I, RUI attorneys. But let's dive into it here about what we're talking about. So on April 28th of this year, so just a little while ago, so just about a month ago, Joe Biden and the Democrats, they trotted out a new tax plan. And we're talking about the federal. So what is interesting about this is the first thing, before anybody gets really, really scared about this, the American Families Plan, is do be aware the American Families Plan is a wish list. It's a list of many, many things that the Biden administration and the Democratic Congress would like to have happen. But what's actually going to happen is a little bit iffy. Some things maybe have higher likelihood, and we'll do our coin flip. We'll kind of make a guess on the ones that are more likely to happen. And then the ones that are maybe unlikely to happen, we'll kind of spot those and call those out, that those may be less likely to happen. So what is interesting with the American Families Plan is that it is seeking to raise taxes in a lot broader, far broader areas than was initially expected, particularly the income tax. So one of the first things that we're seeing that was in the American Families Plan that we were seeing only somewhat in the Biden campaign proposals was raising this top individual rate. So what this is right now, the top individual rate generally hits people that are around, $523,000 per year in income, a lot, $523,000 for single filers and about $628,000 for joint filers for 2021. Under the Biden plan and this American Families Plan, the general thought is that this is going to start to slide down. We're going to slide down the threshold of what triggers the highest marginal rate. And right now, fun trivia, the highest marginal rate is 37%. The American Families proposal is that the highest marginal rate for income tax should be 39.6. So that's 2.6% jump. There'd be a 2.6% jump on that, on the highest marginal rate. And the bracket is actually going to go down. So right now, for individual filers, it's, like we said, 523, highest marginal bracket. There's a general thought that this is going to be pushed down to around 400,000, 452. That's going to trigger the highest marginal bracket for individuals. Polling around, checking, some of my local sources, polling the accounting firms, Grant Thornton, the major accounting firms, Price Waterhouse, KPMG, everybody, along with the law firms. Generally, most people, and Bloomberg Tax, generally so people in the know are saying this raising of the top marginal bracket, likelihood of this, pretty high. This is probably coming. The good news is that most of us don't earn over $452,000 a year. It may not affect us, but this raising of the top bracket, that's probably going to happen. The next thing that's likely going to happen is raising the top capital gains tax rate for households with more than $1 million in income. So this is another one where right now our top marginal bracket is not as high. The top marginal bracket is generally, for top capital gains tax rate is generally, the 20 plus 3.8%. Try to, generally staying around there. It's vacillated between as low as 15% and then up to 20. This one is basically including another bracket, into the capital gains tax structure, and it's going to be a fairly high bracket that's going to occur at this more than $1 million of income level. This is actually something to really watch out for, those persons with real estate, because again, there's a thought of people say, well, I don't earn over $1 million in income. Well, you better be watching this, because what if you're liquidating a rental and you're getting into those higher brackets? This may be something that one will want to take a look at, thinking about his or her real estate holdings or business holdings, is that, well, actually, if I do a liquidation, what if I trigger, this, fairly substantial, now nearly 40%, capital gains tax rate here? That could be a big problem. In addition, again, not to scare everybody, I feel like this should be my Halloween lecture, and I should be wearing a costume or something, scaring people with the taxes. Do remember that California also charges the highest bracket is 13%. California has trotted out that maybe this should be 16%. You start adding these together, it gets very, very high. So looking at this one, again, polling, those in the know, a lot of people, Grant Thornton, all of the pals at Bloomberg and all of them say, this one looks pretty highly likely too, that the top marginal bracket for capital gains for households with income more than $1 million may go up to 39%. This looks pretty likely. Question that everybody says, well, what can I do? What can I do? The first one, the 39% for the top individual's income, that's hard. That's hard to structure. If you're earning W-2 income or you're just earning bonus income, that's hard to structure. But capital gains taxes, that we can do something because we can control the timing of when you receive the income. So first thing, of course, keep in touch with all of us on our Tuesday afternoon networking, so you know when this is coming. Just like Prop 19, I think everybody knew about 2 months ahead that it was coming. So of course, keep on the lookout here. We'll tell you when it's coming. So of course, before it's enacted, you can potentially do a transaction. Also, one of the things that may be in play here, a lot of people in real estate would say, oh, well, that doesn't matter. I'm just going to do a 1031 exchange. Well, we'll have to see about that. That may not be so workable, as we'll see in a few spaces here. One of the other things that one can do, in addition to timing your transaction, there's another transaction that's a very attractive transaction that likely wouldn't be affected by the American Families Plan, which is the charitable remainder trust. So if you have a property and you say, it will trigger a lot of capital gain all in one go, and it could be subject to this $1 million issue, I may have a problem here. Maybe what we need to be, but I do want to sell it. I have to get rid of this thing. What can I do? We may want to start to talk about the charitable remainder trust. This is a trust that actually is created by the IRS. They actually like this trust because it encourages charitable giving. And this is a particular kind of irrevocable trust where I take my rental property that hopefully is my free and clear rental property that I've depreciated all of the basis out. So I've depreciated all of the basis over the 10 years that I've owned it or however long. So I have no more basis. I just have a big capital gains pile right here. But what I can do, and the IRS tells me I can do this, is I can create this charitable remainder trust, create the trust, I throw my property in there. The trust sells it. Trust sells it, it has money. It then invests the money and it pays me, essentially it seems like an annuity back for a set period of time. And then per the trust, it must be structured the way the annuity works, that after the payment period, 10% is given to a charity. That's a classic, public charity. Of course, for doing this, I get a charitable deduction in year one, and I turn my capital gains issue, instead of a big lump all in the beginning that may be subject to a very, very high tax, I can stretch it out for many, many years and pay at the lower rate. And instead of having, again, the big lump sum, I have the stream of income, which is very, very attractive. So that's something that I think we may be seeing in terms of, what's the problem? What's the plan? Problem that we'll see individual and capital gains taxes likely increasing. Everybody seems to be indicating 2022, 2023, this may be in the works. But a lot of the classic planning for capital gains tax, maybe not 1031 exchange, we'll see, maybe it will still be in play, will still work, such as the charitable remainder trust. So we do have options if you have properties that you say, I wish to sell this, but I need to change the capital gains treatment. So that is looking likely over there. Additional things that are changing, the 3.8% Medicare tax, that's the surtax over $200,000. So there used to be, and if anyone sold a property or sold substantial amounts of stock, generally the 3.8 surtax, that we used to call this the Obamacare tax or the Obama tax, that used to kick in for the Affordable Care Act, used to trigger for capital gains transactions over $200,000. The first $200,000, this didn't kick in, and then it would kick in for the amounts over $200,000. The thought is this 3.8, that this is going to get kicked down, that it's going to apply for all transactions, regardless of the value. It's not going to have a dollar figure there. Again, this will likely be folded into this 3.9. It will likely be part of this, so you probably won't see it separate. But the bottom line is that for the lower brackets, though, so again, this won't be added to this, you may find some of the lower brackets will go up too. As we mentioned before, if we have increased capital gains, we can generally handle it. It's just the key thing is to come talk to me before you do the transaction. Before you do the transaction, we can maybe you do some clever structuring. I do have many clients that generally happens around November and December that usually kind of spoil my Thanksgiving. I do get a flood of people saying, oh, in June, I sold all this stock or I sold this house. And then I talked to my accountant and he said, I have to pay this amount of tax. What can we do? I say, not very much. You should have seen me in June. So since we are in June now, I'm heading you off at the pass. So before doing the transaction, let me know. Right now, we still have the old system. This is all proposed. One other thing, if I didn't scare you enough, that one has to be a little bit careful with, is there is history in the Internal Revenue Code that capital gains tax rate increases can occasionally be retroactive. So it can occasionally, if we pass the law in June, we can say it applies all the way back to January of this year. It can be for the whole year. So again, just be mindful of some of these things and keep an eye on the news. 2021, we look like we're totally clear. We look like we're all right. So far, so good. But maybe 2022, 2023, keep an eye on the news. There may be a challenge there. So those are all capital gains tax items for active transactions. Here's another thing that I was shocked to see in the American Families Plan. This has been getting a lot of press for good reason. A repeal of the step up in basis for some kinds of inherited assets. This is a big surprise for anyone who's been in tax planning because the step up in basis, section 1014 of the code, this has been in the code for a really long time. So the tax code got changed. There's a big change in 1983. That's sort of the big restructuring of the code. The step up in basis, section 1014, was even before that. That was in the 1954 Act. So even in 1954, we had this. So we've had this a good long time, this idea of step up in basis. And what is step up in basis? Basically, step up in basis is this. I'm grandpa. I have all of these assets. I have houses, I have stock, I have all of these things. And let's say my rental property, again, I've been renting it for years and years. I've taken depreciation. My basis is zero. If I sell it, grandpa, I have 100% capital gains. The same way my primary residence, well, I have the section 121 on that. So 250 is exempt, but anything over that, I have capital gains. And all of my non-retirement assets, all of my portfolio holdings, I have potential capital gains on there because I have a buy and hold strategy. I have all of these things. Step up in basis is if I sell them, capital gains. But if I die, I pass away, and ideally these things go through my revocable living trust, so I avoid probate, go through my trust, my heirs receive them tax-free because the basis stepped up to fair market value. So if my heirs say, oh, we're very sad that grandpa has left, but he did leave several $1 million, which, well, my accountant and lawyers say I don't have to pay tax on if I liquidate. Well, I guess the sadness is going away. So this used to be, as I mentioned, long history in the code all the way back to 1954. But as we just passed through, probably one of the worst years in all of our memories, the government has a very, very significant funding deficit. So as we see, these top rates increasing, the government needs money. And one of the first things that was proposed in addition to the rate increases was they say, this step up in basis should go away. Why are people who have all of these assets evading the capital gains tax just because they die? Just because they die, we should be still able to tax them. We should be able to grab these assets. So there is a lot of talk now of this adjustment or change in the step up in basis, and it was trotted out right in the American Families Plan. As I mentioned right at the beginning of introducing this, this is unusual because this has been around since the 1954 Act. This generally was kind of a sacrosanct thing in the tax code that we didn't touch. So this is something that we all need to be very aware of how this works, because one of the strategies, myself included, as many estate planning attorneys, we really used to rely on the step up in basis is that we'd say, well, just hold on to these properties. If you have a lot of built-in capital gain, okay, maybe charitable remainder trust. But if not, if you're in the senior generation, just hang on to it, do your trust planning, and then when the time comes, we'll allow the step up in basis, especially for husband and wife community property. It steps up twice, we'll just let the step up in basis wash out the capital gains. And oftentimes we'd say the surviving spouse will liquidate at that time because we'll wash out the capital gains with the step up in basis. That may no longer be the law. We don't know. So this is another one where we want to keep an eye on this, because if step up in basis is either repealed or it's adjusted, we may be the old strategy, the strategy that we used to use, hold and pass through the trust, may not be so tax efficient. We may have more incentive to liquidate or structure before. So we may want to consider selling earlier rather than later, or maybe we have to structure something at that time. So the other thing with the step up in basis is there's been a lot of talk of the total repeal of the step up in basis. My guess, this is the coin flip again. I'm going to make a kind of a bet. We'll see what happens. My guess on the step up in basis is if they're going to adjust it, it probably won't be a total repeal. My guess is they might do something like California did, like with Prop 19, or even the earlier, the Prop 58, that they'd say, okay, you get a step up in basis on a primary residence of $1 million and maybe something else of like $500,000, but then everything else, that there's a cap to it. I could see them doing a cap. If they do a total repeal, that's pretty aggressive, but we'll see. I think a cap would be more palatable. In terms of politics, this one, the step up in basis, is the riskiest one. That's going to get the most pushback. These ones here, I think they're probably pretty high odds that they can go through. This one pretty tough. This next one, carried interest as ordinary income, that's for our hedge fund friends that may be on the call. That one may be coming. If you operate hedge fund and you have this particular tax transaction called carried interest, that was generally taxed at capital gains rate rather than the ordinary rate. That's pretty likely, but that's a pretty narrow transaction. As we mentioned before, like-kind exchanges, the 1031 exchange. The proposal is actually a little bit more complex than this. The proposal is actually that this would be more capped. It wouldn't be eliminated, that it would be applicable for gains over $500,000. If you were doing a smaller transaction, you could still do it. Of course, in the Valley, $500,000 transaction is a small transaction. In Wichita, Kansas, that's the biggest transaction that they had. In the Valley, we say, oh, that must have been a not so great rental. But so that's something that is another thing that we have to sort of pair and couple, like-kind exchanges, step up in basis, and the capital gains tax rate. We want to keep an eye on all of these three things because our real estate strategy may be different on this. Again, the ultimate objective, if I want to sell, we can probably still sell. We have many ways where we can do that. Charitable remainder trust, all of these things where we can still do it. But we want to be cognizant of what the rates are and what the rules are. Classic step up in basis, I have many, many clients that they just collect properties. That may not be an effective strategy if the step up in basis gets adjusted. Maybe some of those properties we should liquidate. Maybe we should liquidate through charitable remainder trust, convert it to income, and convert to another kind of asset class. So these three things we want to take a look at. Like-kind exchanges can be quite, if this gets repealed, can be a little bit of a problem because it's very, very popular in Silicon Valley to use this to convert assets, convert from residential to commercial, convert from an initial sort of first-time starter commercial to maybe a more substantial commercial. We use like-kind exchanges a lot. So this could be an issue that we see as a significant problem. We'll have to see. Again, in ranking of things that is this likely, one could see this being a target, it's kind of an easy throw-in because it only affects real estate investors generally. It's a narrower swath of people, but at the same time, it doesn't raise a lot of revenue. Like this step up in basis, this is going to raise a lot of revenue. This one, maybe not so much. So we'll see where that goes. The 461I loss limitation, or L loss limitation, that one, that's just business losses. That was in the Tax Cuts and Jobs Act, the 2017 Trump Act. It limited certain business losses to $250,000. That one, that's probably coming. That's of limited applicability. The next one is the one that makes me nervous in a few ways. One of the other parts of the American Families Plan that is different from particularly the 2017 Tax Cuts and Jobs Act, and particularly the Trump administration in general, and this was actually also even true for the end of the Obama administration to a large extent. The Obama administration, and then definitely the Trump administration, did not heavily fund the IRS very much. Tax audits were generally pretty low. The percentage of auditing was relatively low in the second half of the Obama administration, and in the Trump administration was very, very low, and the IRS was really, really starved of funding. So generally, the instructions during the Trump administration for audits was really major taxpayers that are low-hanging fruit. So generally speaking, with my old friends in the chief counsel's office, generally they said our instruction was very, very high net worth or income persons that triggered, we call it the low-hanging fruit, triggered an obvious problem such as not filing a return or not reporting a transaction. So generally what the auditors were instructed prior to the current Biden administration and the American Families Plan was just grab taxpayers that had some obvious massive flaw that we can just, we know we're going to get some taxes. If it's a close call, it's murky, just let that pass. We don't have time for that. We don't have enough people. Just, that person didn't file the 2019 return. Oh, of course, audit them because, it's obvious. We're at least going to get them. We're going to get them on whatever the tax was, plus the non-filing penalty. And if, depending on what they did file, maybe we'll get them for the negligence penalty. Great, it's very easy. Don't get the person who has a complicated return that maybe we're right, maybe we're wrong. Don't bother with that person. That's going to change, apparently, with the American Families Plan. The thought for the American Families Plan is that they want to put $80 billion into the IRS and actually over 10 years put $700 billion into the IRS with very, very aggressive funding of the IRS, basically their enforcement arm and their technology modernization arm and their sort of bank and financial institution reporting review and really, really hyper fund the IRS. There has been some thought that the IRS has been under collecting taxes, that basically underreporters have been sort of getting away scot-free, partly because has been the instruction under the Trump administration, and to some extent the Obama administration, of just say, aim at this low-hanging fruit. If maybe it's an underreporting issue and there's a filed return and there's not an obvious mismatch, like basically the 1099s and the W-2s and everything, that adds up and it looks basically right and everything was filed timely and timely paid, generally they were saying move on. The thought now is that should change. This should go back to some of the earlier sort of 1990s, even maybe the 1980s enforcement levels where they were pretty tough. This one is what's my coin flip on this one? What's my thought on this one? There's probably going to be some additional funding for the IRS, but I'm a little bit skeptical of the level of auditing, where it's going to go and whether it's going to affect general taxpayers. Years and years ago, worked for the IRS chief counsel's office, and generally then, this was in the earlier part of the Obama administration and end of the Bush administration, generally the both administrations don't like the IRS to be poking at people because it's bad for voting. People don't like that. People don't like to be audited. People don't like when the IRS comes to your business or comes to your house. They generally, what the IRS prefers to do is the same thing with the low-hanging fruit, is when they come by, the taxpayer, even him or herself, realizes, oh, I obviously did something wrong. I didn't file a return, or the return I filed was just totally false. And the person kind of says, you got me. People generally don't like when people are in good faith trying to comply, and you get scrutinized and you get scrutinized and you get scrutinized, and you end up with a lot of trouble over things that are really not your fault, or you think is sort of an innocent error, or something that's just not up to the level of federal government enforcement. So this one is a little bit iffy on if this is going to make some change or not. I do expect some significant funding to increase for the IRS, because they've been on a very, very sort of shoestring budget for a long time. There probably will be an increase in funding, but in another hand, you have to be careful, and this is just, again, coin flip, sort of fortune telling here. The government always has to be a little bit careful when one funds any administrative agency, because if you overfund the administrative agency, you basically have to, like any family, you have to create a budget. What you don't want to do is sort of create a large budget and then have the budget collapse in the year after. Large budget and then the budget collapse. That actually tends to be worse than if you just didn't fund them very much at all, because you end up basically, like anybody who runs a business, you overexpand the business, then all of a sudden, you have this like contraction, and then you overexpand and contract. That generally is worse for the IRS than if you just sort of say, it's going to be this way, just sort of keep the plane, sort of level and steady. That tends to be better. So we'll have to see, but I would expect in the coming years, there will be more funding, and there will probably be more audits. Where do the audits usually come? The audits usually come to the self-employed, real estate investors, again, people who do not have automatic withholding. If you're pure W-2, you're probably not going to have very much happening. But if you have things where you have a lot of self-reporting, there can be an issue. There's a question about the 1031 exchange. If there's a situation of where it would go forward, I expect actually with the 1031 exchange, that I would be shocked if that was retroactive. That one, I think the Congress, if they're going to do it, they have to have an effective date, and it has to be in the future so that people can plan transactions. It would be pretty unfair to retroactively remove the Section 1031 in a way that previously structured transactions would be recharacterized. So generally, I would expect for the 1031 exchange, there would be an effective date that they'd say, okay, 2023, it's effective January 1st, at midnight, 2023, no 1031 exchanges that year, but everything backward will be okay. That's how I envision it. But like I mentioned, for the capital gains tax rate, there is precedent for rate changes to be retroactive. In fact, the capital gains tax is the example, that if they're just changing the rate, that can be retroactive. So generally, if it's something where it's a rate change, or like we used to talk about the estate tax exemptions, if it's basically just dialing a number, there is precedent that can be done retroactively. But major code revisions, the same way like the step up in basis, the step up in basis generally has to have an effective date that's in the future or concurrent with the passage of the bill, which again, concurrent with the passage of the bill doesn't happen, moving at the speed of government. That's the slang. Moving at the speed of government, we'll know if the like-kind exchange repeal is in queue or the step up in basis is in queue. Right now, not. So for that one, I don't expect a retroactive effect to that. They likely have an effective date. And if you're on one side, you're okay. If you're on the other side, you're not. So that's basically the areas that we see in the American Families Plan. And you can take a look on the White House website. There's the American Families Plan. You can take a look. They have all kinds of things there about it. So these are the main things that were mentioned in the American Families Plan. But what is interesting, there are a number of things that were not mentioned there that didn't get into the plan. So these may be in queue, they may be not in queue, but they at least didn't raise to the level that they got into the plan. So if anyone has a pass-through company, there's been the section, 199A deduction. There's this thought that this would be phased out for certain incomes, that they would phase out the 199A deduction. Didn't make it in. Partly because I don't think the 199A deduction is being utilized so much. It's a little bit hard to use. So only certain pass-through businesses are able to use the 199A deduction. So that one, maybe not so much going on there. Here's one that I was shocked to not see this in the American Families Plan: increasing the gift and estate tax rates and reducing the exemptions. That was in the Obama or the Biden campaign proposal. We talked about that all in December, in January, in February. We talked about this over and over and over again, that the estate tax, gift tax rates are going to go up and the exemptions are going to go down. Didn't even make it into the plan. Didn't make it into the plan. Not sure why. Not sure whether it's coming. There may be one thought, though, that the gossip is that the estate tax exemption is already going down 2025. It's going from 11 million, now it's 11,700,000, going to slide down to 5 million, adjusted for inflation. There have been some that say the thing's already going down. It's already reducing automatically. We don't have to do anything. Do we really need to squeeze another $1 million out of that, or squeeze another $1.5 million and put it to 3.5? I suppose we could squeeze a little bit more out of this lemon, but yeah, maybe we should go someplace else. Also, the estate tax, while it's a major issue in the Bay Area, California, New York, Florida, to some extent, Washington State to some extent, it's really not a big revenue raiser for the federal government. So it seems like it's getting skipped. The other thing that is to the chagrin of Californians and New Yorkers, but much to Californians, is there was a thought, and this has been very popular amongst Democratic congresspersons, that the SALT deduction, this is the bad part of the 2017, the Tax Cuts and Jobs Act, where it capped our ability to deduct state and local taxes. There was some thought that this should be repealed, and that the federal government should repeal the cap. The problem with this, and why it was not in the plan, is likely because it's a political hot potato. Why is it a political hot potato? I'll give the Trump administration, this was pretty clever. When they were reducing taxes broadly in the 2017 Tax Cuts and Jobs Act, they did increase taxes and kick up the taxes for some people. How did they do it? They did it by creating this thing called the SALT deduction cap. When you filed your taxes likely on the 17th of last month, and you were doing your Schedule A, and you're doing your Schedule A, and you realize, wait a minute, why are my property taxes and my state income tax, why is it hitting 10,000 and it's not letting me take any more? That's the cap. That's the limit. So what the 2017 Tax Cuts and Jobs Act did is it said these persons such as us in the Bay Area who pay high state and local taxes, we're not going to let you deduct all of that off of the federal. We're only going to let you take 10 grand off of the federal. The rest is just going to be non-deductible. So it was pretty clever in terms of tax policy because you were reducing taxes everywhere else, but you threw a right hook tax increase to basically most Democratic states, California, Washington State, New York. You punched up taxes for all of them. This is a political hot potato because if you repeal this, this will reduce taxes for Californians and New Yorkers, but it doesn't do anything for Wichita, Kansas. It doesn't do anything for Arkansas. It doesn't do anything even much of Texas. It's not going to do anything for them. So it's a little bit of this dilemma that the Biden administration has is because if we repeal the limit on the SALT deduction, that will lower taxes for Californians, for blue states, but we're raising taxes other places. So like we're lowering here for us, but raising for others. Politically, this is a little bit hard to deal with. So didn't make it into the plan. We'll see. There are many congresspersons that are dead set that they want to repeal this SALT deduction, but we'll have to see. It's a political hot potato. Itemized deductions, this cap on the itemized deductions at 28%. Nobody likes this thing. This is pretty unpopular. So that's probably not going to go very far over there. And then the same way with imposing the Social Security taxes on income exceeding $400,000. That's another one that's somewhat unlikely. So with that, these things didn't make it into the plan, but they are have been talked about and have been kind of floating around here for a while. So we'll have to see on these to determine what is going to happen. We'll just take a look at a couple of other things here, and I might skip forward onto our Prop 19 just to take a look at it. This is just a little bit here for individual tax changes, just a little bit of the legislation. The top marginal bracket to 39%, that's already been introduced in the House, as we see, February, that's already in there. So that one's maybe has some legs, some staying power. There's a bill by Ted Cruz to make 2017 Act permanent. That's probably not going to go anywhere. Same thing. Same thing going over here for the business tax changes, reinstating the upper percent. That's already been proposed. That's out there. There have been some other Sanders proposals, but those really don't have very much legs. Don't really have legs. Probably not going to go out there. This is basically a corporate tax increase based on ratio of pay. That's probably not going to go anywhere. It's just something to talk about. So probably nothing going on there. Estate taxes. We'll just talk about this just briefly before we move on to our Prop 19 review and double check here. In the campaign, there was a lot of talk about reducing the exemption to $3.5 million, rate up to 45%. But this basically focused on the end of the step up in basis, but didn't talk at all about the rate increase or the exemption decrease. So there seems to be not very much happening in the estate gift tax arena right now. That's good. Why is that good? Is because planning can occur. There's not a lot of aggressive action here. So anyone who is thinking about structured gifting, thinking about all of these things, may have a good opportunity here to begin planning, because the estate tax, the barn door is kind of left open on this. So for right now, looks like we can do some pretty good planning over here. Not much is changing, and we've gotten some sort of heads up for the capital gains tax, general income tax, that there may be increases there. Do we start structuring that yet? Maybe not yet, unless you were planning to do it already. Again, coin toss, hard to predict on these things. But if one was going in that direction, one may, think that way. Major accounting firm that does a lot of estimating on this, Grant Thornton, they put out that they generally expect the increases are coming. So for what it's worth, for 2 cents, that's their thought. Let's shift gears a little bit briefly here, just onto our refresh of Proposition 19. We spoke a few weeks ago, or I think a month ago or so, about Proposition 19. It is here. The sky hasn't fallen so far, but it is a sort of different world than it used to be. The key thing is these things actually really go together, this base value transfer and the parent-child exclusion. So the good thing about the Proposition 19, which is very attractive, is for primary residence, for persons aged at least 55 or disabled, they can carry their base value with them to a new residence. So you don't have to be stuck. And really, we're probably thinking for our parents. Our parents don't have to be trapped in a house that's too big for them, but they say, well, I keep it because if I were to sell it, I'd, wherever I bought, I'd get, an increase in the property tax unless I bought something smaller or something less. I don't really want to do that. I kind of want the same style of living that I have. This has been very good. This seems to be working out. So for the principal residence, you've got that, and then the purchase or newly constructed residence within 2 years of sale. So again, you can sell, you don't have to, it's not like a 1031 exchange where you have these rigid timing rules. You can generally do this within 2 years of the sale. So you can do that. And like we said, you can do it anywhere in the county. So since you can do it, or anywhere, I'm sorry, in California, you don't have to be stuck in the same county or in that old system where there are 10 counties that used to do it. And you'd say, oh, well, I have to move to like one of these 9 counties. If I was in one that qualified in the beginning, that's all gone. So now you can move anywhere in California. So that's good there. You also have, again, you don't have this value restriction. So there used to be under the old law, there were these different value restrictions of 100% or 105 and all of these different things like that. This one is you don't have the value limitation. So that is just fine. You can do this 3 times. So you can move a few times. If you're over age 55, you can do it 3 times. And then they'll come up with the statutes. April 1st was the implementing date. That was the effective date. So we are good. So we can start thinking about how this works. And one can go and use this. This is very effective to think about how these things interlink and how these go together, is thinking about this base value transfer and then going all the way back up to our American Families Act thinking about this step up in basis capital gains tax rate. If husband and wife have a pretty solid property, they have substantial gains, but they are under the Section 121 exemption, under the $500,000 gain, and they want to downsize, it may be a good time to utilize this base value transfer, utilize the $500,000, exempt that capital gain, and then use that $500,000 somewhere else in the estate. Because if one was relying on the step up in basis, well, we have to see whether that's available or not. So that is the base value transfer. And then this is something I still see problems with this almost bi-daily. So almost every 2 days, I see a problem with this. This is the parent-child, grandparent-grandchild exclusion. The base value transfers, I think generally is working out relatively well, partly because it's the good part of the law. Most people are understanding that part of the law and utilizing it pretty well. One just has to remember you have to file to claim it. You have to actually do the claim and then get that firmed up once you file. But this one I am still seeing problems with for 2 things. This is the parent-child exclusion. This is substantially different than it used to be. And I'm seeing people already start to make some mistakes on this and make some problems. This became the law and became the effective date on February 16th of this year. So that's long past. So with this being the law, one also really needs to think about one's holdings. And I'm going to pivot more towards rental properties because that's the easier one to think about. And the old law, you used to have this wild card where you could transfer your lifetime limit of basically this $1 million factored base value to your rental properties. And you used to be able to stick it on the base values of these rental properties and basically preserve the property tax basis of rentals. And that was the former law, Prop 58. That's all gone now. So whenever someone's planning an estate or planning to gift or transfer property, parent to child, for rental properties, you generally have to assume that the property tax basis is going to be reset. It's going to be stepped up to the fair market value at the time of the transfer, either the time of the passing of the person where there's a transfer, or at the time of the gift. So for rental properties, one really needs to consider, you're looking at the profitability of the particular property. If that rental was increased to the fair market value property tax, is that still a profitable rental property or not? So really what people should be thinking about is, do we keep these things and do we hang on to them, or do we look for ways to maybe liquidate them and change the investment strategy to something else? Again, linking these things, if where we could have a key problem. If we have a situation where it's a rental property, it will be reassessed because it will go to your parent to child, or it goes to anybody. It's going to be reassessed for property tax purposes. We have to keep looking at that thing we mentioned for the federal tax system, is what if there's no step up in basis? A lot of people say, well, if we get the step up in basis, that's fine, because the step up in basis is worth it, even though there may be a brief period of time where we have increased property tax. We'll hang on to it. It will pass through our estate. And then from there, the children will only own it for a few months. They'll sell it. There'll be a couple of months of the high property tax, but then they'll sell it, no capital gains. Well, these are interrelated. If the step up in basis gets reduced or repealed, then that whole situation will be very problematic to use that strategy of we'll pass it off to the children, because the children will receive no step up in basis and an increase in the property tax basis. In that situation, maybe it's going to be better that the parents deal with it, or it's dealt with through another way. So it's definitely something to look at. The converse of this is for primary residence. There is the $1 million worth of value on the primary residence. There is now essentially a dollar cap on the primary residence, parent to child. So estate planning that had family home to the children, that still is functional. Only one child has to live there. So again, the BOE clarified that they say it's just one child has to live there. But with that, the other thing that is a problem is that with the new Prop 19, one child always has to live there. So if first child lives there, they can keep the property tax basis. First child goes, second child comes back, still, unbroken chain of child to child. It stays at the old property tax basis. But as soon as both children move out and it becomes a rental, it gets reassessed. As soon as a child claims basically the homeowner's exemption on another property, then you're going to have a problem. So Prop 19, is there much news over there? Not so much news. It's really just settling it up. But what is new is that the Prop 19 patterns and the basically different sort of flow charts of the results really do need to start to be tied to the federal changes, because with Prop 19 changing, and if we have changes on the federal level, some of the old strategies maybe don't make such good sense. Some old strategies, which used to be decent strategies, have a lot of rental properties, take a lot of depreciation, to keep the income taxes low, and then when one passes away, we pass them to the next generation and wash out the capital gains with the step up in basis. And that technique, we don't know about that. There's a question mark on that technique. That same technique that we used to do under the Prop 58, where we could place the $1 million on the rentals to prevent property tax increases. Well, we know that's gone, but maybe it wasn't so bad if we still had step up in basis. But if we don't have step up in basis, now the strategy looks not so good. Now we have to do other things. So that's the thing, the key takeaway that I have for you on the Prop 19 front is that Prop 19 base value transfer, that looks good. The parent-child exclusion, be mindful of this. People are still making mistakes and some confusion about how it works. And then the second thing is that we have to be aware that this will tie to the federal changes as well. We don't know what the federal changes are. We basically just have a very, very rough roadmap with the Biden plan that has been put out, the American Families Plan. We don't really know what's going to happen there. It's still quite up in the air. Like I said, the prognostications that everybody has been making is they say it's been going up. but it may be somewhat slow when it goes up. And it seems that there's probably going to be reasonable warning before it goes up. So something to keep an eye on. We'll probably, of course, be chatting again, maybe late summer or the fall. We may know more then. Usually there's some congressional activity in the fall, and we would know at about that time what is coming down the pike and what may be in queue. So that's all I have for you. I know it's a little bit of it's kind of a lot, but that would be that's what we've got, because right now basically it's all plans right now. We're just watching as to, as Coco said, it's the coin flip day. It's sort of the up in the air, maybe one way and maybe the other. That's where we are seasonally. We're post tax filing, corporate tax filings, of course, in the fall, but we're post individual tax filing. We have the American Families Plan. We have a few things in Congress, but right now we're not certain where it's going to go. Later in the fall, likely going to firm up a little bit, as it usually does. So if you have any questions, I'm happy to reply, and I wish you all a good night.
Great, thank you so much. That's a lot of information.
Yeah.
Yeah, maybe we can unshare for a moment, and let's,
Yes.
right now is a good time to gather all your thoughts and type your questions to our co-host. We have also collected some questions from streaming on other platforms, including Facebook, YouTube, and Ichibo. So are you ready for the questions and answer, Michael?
Yes, I'll try my best to see what
We'll
I
make
can
it
do.
fast. Okay. So, all right. So from Tamra, when using Proposition 19 transfer, can the title of the new home change? So basically, can mom and dad sell a home, buy a new home with mom, dad, and child on the title, and then still fully transfer the property tax base to the new home?
Okay, so this is going to be a little bit of a problem, actually. So if you have 3 people on the title, generally what's likely going to happen is that for the over 55, that portion there, let's say if they're 2/3, that portion will be the same, but the child transfer, that will not be the same. That will likely that will not be subject to the property tax change. Strategy on this one may be subject to some strategy. So thinking about this, if we're, let's say mom, dad, and son all on the property, and it's our primary residence, or at least the parent's primary residence, this may be one, again, we'd want to take a look at it, but there's a potential strategy where perhaps before this sale, if the property, that portion is less than $1 million, potentially maybe the child will deed off to the parents. They will take title 100%, and then they will acquire the new property whole themselves. That may be the better strategy rather than doing the fractional title. So my thought would be, again, we'd want to take a look at the specific transaction. We have to know the values, all of these things, but that would be one that maybe you want to do it in steps, because if it's broken up, you could have a problem.
Okay, and then going to Naresh's question, does the 55 years old rule for Proposition 19 apply to both husband and wife? Would they both have to be 55 years old for community property, or just one of them?
Luckily, just one of them.
Okay.
So if anyone is over 55, it will be okay.
Okay. Can one use the charitable remainder trust to sell property and transfer property tax basis with Proposition 19?
Well, this, not really. Partly because of this, is that generally the charitable remainder trust, the design is that you, more often than not, do not continue to own the property. Generally, the idea with the charitable remainder trust is that we have a property that I want to sell. I actually don't want the property anymore. So it's really an objective that I kind of don't care about Prop 19. Maybe I have a Prop 19 problem in that I can't get it to my kids. It's a rental or it's something like that. I just can't do anything with it. And I say, instead of having this property, I'd really like to have a stream of income. It works great for that. Prop 19 doesn't really help. Okay.
Capital gain tax rate could increase to 39.6% for those who are making $1 million or more. Is that for an individual? And also, what is the amount for MFJ?
Oh, yes. So that's married filing jointly. So this is the thing about this, and this is a little bit of a problem for the American Families Act. It's not super clear what they mean by $1 million, whether they mean gross or adjusted gross, or do they mean, just like you said, is that the rate for single, or is it married filing jointly, or where does this work? So generally the thought for this is that this is probably, a threshold amount. My guess is it's probably for the individual filer, and then the married filing joint may be slightly higher, and maybe like 1.2 or something like that, because that's when they talked about the 39%, the general income tax rate. That's how they did it, is that they said, well, 400,000, and they said, well, that's the individual, and then married is actually like five something, actually I think it's six something that they said for married filing jointly. So it's probably something like that. If that happens, it's generally going to be for the highest marginal brackets. And just like we said, if you have the problem in the highest marginal brackets, if you say which could happen, is because the way it backfills. So like if I sell something that has $2 million worth of gain, I will end up in that bracket. Even though my ordinary income, I say, oh, my ordinary income is only $150,000. If I sell something and I have the capital gains, it backfills and triggers the increase. So that would be a classic one where I would say, if one is planning to liquidate something that one says, I have capital gains on this, talk to somebody early and begin planning it, because generally you can always sell it. We can structure something that will work. But if you see us early, we can do a lot more for you. And now, this is not me being the lawyer, but just seeing what my clients are doing. Selling is hot now, insanely hot. People, I'll tell you my parents sold my family house in between last time I saw you. They were in last year during, like, right before COVID, they were in contract. The person fell out of contract. They ended up basically relisting it. This is way down in Southern California, relisting it this year, and I think it was like something like 30% higher than like huge. So there's a lot of really attractive selling going on. So if one is looking at these properties and thinking that the market looks good, I'm a little worried about those capital gains tax changes coming down the pike and the 1031 going away. And my options, and a lot of people will say this, which makes sense, is to say my options are kind of limiting, because it used to be the rate was lower. It used to be there was still 1031 on the table. And then maybe some people will look at charitable remainder and say, I'm not insurable. I can't get life insurance. That doesn't work for me. I can't do CRT. Maybe we want to start looking earlier, start seeing what we can do, because there are potential changes coming on. So that's something to take a look at.
I bet you the seller must be happy the buyer backed out last year.
Oh, my parents were thrilled. They were thrilled. They said we couldn't be happier that the buyer couldn't close last year. They were so disappointed right before COVID, and they said, we're stuck with this thing, and COVID's happening. And then now everybody, I think, is thinking, ooh, I'm glad that fell
Exactly. This happens, yeah.
It does.
Yeah. Interesting story. Sometimes buyer thought they paid too much and they backed out and lost 3% deposit. And I bet you the buyer probably regretted so much.
It's an irony of the way that it works, but as always, to keep track of is, like we're saying, this state part, federal part, and of course, coming onto these seminars, and why it's always so good to take a look is because you have to keep track of all these things. You have to take a look at how's the market doing, how's the taxes, where's the taxes going, because they're all gears. You turn one thing and other things turn. So always
That's
good
right.
to be aware of.
We need to plan ahead. Yeah. So next question, right? We have a few more. Would the increased capital gain tax rate be applied to the capital gain over $1 million and lower rate applied to the amount up to $1 million, or will it apply to the entire gain?
It will be graduated. So it will be just amounts over the $1 million, but there is a strong thought that the other rates will also go up, particularly if that Medi-Cal or the Medicare 3.8 that will drop down. So the lower rate where that used to not apply to the lower $200,000, that probably will. And then the other rates will generally stay the same up until the 1 million. So again, it's not going to hit for an, a lower value transaction, but for a high value transaction, it may be there.
Okay, there are many questions about 1031. So if 1031 is eliminated, from which day would it most likely become to be effective? And will it really be changed by the Biden tax law? And will the repeal of like-kind exchanges also affect the DSTs? So a lot of questions about that.
Yeah, so I think this is the thing that I'd probably say generally before getting, or going too specifically into the 1031 exchange, is that this was thrown into the American Families Act. And it's always hard to tell in these things, like I mentioned at the outset, is the first thing is this is a wish list. So not all of these things are going to actually happen. And they're maybe not always going to happen in the way that we expect. Right now, the proposal is that this would be 1031 would still work for transactions less than $500,000 gain, but then amounts over, it would be the tax would still occur. And this is also, again, the act or the proposal didn't explain how it would deal with this, of whether if you were over $500,000, does the 1031 exchange still work for the first 500? That probably makes sense. And then the rest is sometimes in corporate law, we call the rest is called boot. And then it's called the boot comes out and we the knocked out funds. And do we just tax that? Or does it just not apply at all? It's not really clear. So the 1031 change is pretty speculative right now. It's part of a wish list. It is, the hard to predict whether it's really coming down the pike. And really what I think we would all need to do, and what I would recommend on this, is that we really just have to keep track of the legislation. My guess is if there was legislation, it will have an effective date, that it will say when it will be effective. This is very unlikely to happen like the Prop 19, where Prop 19 just landed in everybody's lap. Even the people at the BOE were like, what is this? Why, this like suddenly is the law? This will be passed through Congress. This will go through regular order, through the regular procedure. This won't suddenly happen. So my expectation is it's really just something that we have to watch. It may never happen. Many of these things, I thought for sure there'd be a decrease in the estate tax exemption and an increase in the rates. Didn't happen. It just wasn't in there. This one's been talked about. It may, if we see legislation, maybe it comes out. There's no legislation out, no legislation is really getting that far, so far. So right now it's just speculative, but it was in the proposal. So something to keep an eye on.
Okay. There's a case study, I guess, but I'm going to have our question collector post that question in the chat so you can read it. But before that, I have another question. If I buy a stock, for example, Facebook, then within a month, sell the same number of shares of Facebook that gained a lot that I bought a year ago. If I classify the lot, which, if I classify this, can I claim long-term capital gain for the sale? Continue the above question, is it a good strategy to do the sale now to take advantage of the lower tax bracket now for long-term capital gain tax?
Oh, this is a little bit of a complicated one. This one will probably better to the person could contact me offline. Generally, you have to hold for the 365 days. So it's actually a holding period. And then when the hold comes off, it's long-term. If you're trying to do something else, it could potentially be a wash sale and other things that are subject to special rules. So feel free to contact me offline on that one. I see the question here. This is
that's almost like a case study. So I have my question collected posted there because it's too long for me to even read it.
Yes, this is
you want to read it?
Oh, yes. This is for a foreign person with capital gains, and whether or not there is basically what this person will do. Right. Well, there are a couple of things that are broadly applicable for this. First thing that I think everybody on our meeting knows, California, there is no rate difference between capital gains and ordinary income for California. There's just a rate. Right now, the highest rate is 13.3%. Is the highest rate for California. Most people don't hit that. That's for very, very high income. Generally, most people fall around the 9-10 rate. So California, will there be an increase in California taxes? There has been a proposal that the highest rate should be up to 16%. That was as of last year. That's kind of stalled. We seem to be just in the regular rate zone now. So California seems to be staying with the ordinary rates. Generally, for someone who is a foreign person, planning to sell, they can't avoid the capital gains tax because of the FERPTA law. So they're going to have to deal with it. And this is when it's actually I think the questioner is, the thought is, well, should we sell now or should we wait? Really hard to tell. Right now, I would really be planning on what is right for your finances, what is right for you, because our perfect theme, coin flip. This is not like December, when we were on the call in December, where I said, I was like shaking the screen and said, people, plan, it's the law, it's coming, you have to do it. Why are you not doing it? This is all guesswork right now. This is the plan gets put out, and we're saying maybe something will happen with Congress, maybe not. I thought it was going to be a little bit different last year. Here it is now. This is highly speculative. Where we should be kind of, if you wanted to make a plan tax-wise, now is just a little bit too early. So now it is it is highly speculative if you're making a plan based on future taxes right now, because we really just don't know. Really, I'd be thinking is if one needs to sell the property, then one needs to think about that. If one likes where the market is, I'd be thinking about that. And one may say, well, if I'm ready to do it now, I'm ready to do it now. And if taxes go up, I made a smart decision. And if they don't, I needed to sell it at the time anyway. So why not? For some of the more nuanced questions, do feel free to email me directly, and I can provide specific questions, because some of these are pretty specific, and we should talk offline.
There are a couple questions in there posted in the Zoom about 1031 property holding period before 1031, and also about your hourly rate.
Oh yeah, yes. So generally, the 1031 holding period, usually people use an exchange agent. So usually from the time of closing the relinquished property, the investor has 45 days to nominate the replacement property, and then 180 days from closing to acquire the replacement property. Generally, if you had something that was a primary residence that you want to switch to a rental, usually you have to do a couple of years to do that, to season it for 1031. Generally, the best way for 1031 exchange answers is to work with the exchange agents. In fact, Coco knows exactly the people to talk about. Come on for the one with 1031s, because they will tell you, and this is the thing, why I often guide everybody to the 1031 exchange agents, is because they structure the transaction and they do it in a way that is not ambiguous. As a lawyer, I sometimes give answers where I say, well, you could be kind of iffy and you can do these things. You don't want surprises. They will tell you exactly. They'll say, you must go get a calendar, highlight these many days, tick them off, then do it. Go with that.
Yeah, I think the question is probably more about how long they have to hold it before they qualify. And we had seminars for 1031 before. So the answer is not straightforward. It really depends what your intention was. So
exactly.
Your true intention, yeah.
Yeah, collecting, did you market it enough? Did the renter, all of those things. And then
exactly.
Hourly rate, it will depend on what we're doing. A lot of things are charged flat fee. We try to do a lot of flat fee for the planning. Some things are hourly. So really, usually what is best is just send us an email or contact via Coco is great. She can help coordinate you to us, and then we will we'll arrange a consultation, figure out, what is an appropriate way to make it fair. So that's the usual way.
Anyone who wants the slides, and then feel free to reach out and we'll send it to you. Yeah. There's one more question. Again, it's about the 1031. I own a hotel in Florida, has $2 million gain. I will need to sell in the next few years, but it makes about $500,000 per year right now. So I want to sell it now only if 1031 will go away in the next couple of years. So that's a very specific question about when the 1031 will go away. Yeah.
And hard to say. We don't see anything right now. It came up in the American Families Plan, kind of gave everybody a little bit of a scare. I think the thing is like with that is it's now on your, on your news feed. You now want articles regarding the 1031 exchange, and come to this because we will, we'll be, mentioning it. If we start to see, this firm up, if what we start to see, and this would be the thing that I'd worry about, like, with the Trump administration, there's the Tax Cuts and Jobs Act, Obama, there was the Affordable Care Act. If we see a comprehensive plan that they call the American Families Act of 2021 fall, that will be the, me shaking the computer saying we got to go do something and saying, the law is sitting there. There's the law. Right now, we don't have that yet. We have American Families Plan. We have kind of hopes and dreams and maybe what we'll do. We need to be aware of it because they're talking about it. And again, things that, 1031 exchange and stuff up in basis, that used to be not something that was normally talked about as being sort of on the table. This time, they're on the table. So we take a look at it.
Yeah, sounds great. So my question collector co-host will drop my email in the chat, and then you can email me for the slides or for additional questions that you have for Michael. This is amazing. Thank you so much, Michael, for your time and your extensive knowledge. We're so lucky to be able to see into the future so that we can be prepared. So those who want to stay and network, feel free. I will stay on for a little bit longer, and I have unmuted. Let's unmute everybody so that feel free to thank Michael as you leave. I'm like my co-host to help me unmute everybody, and make sure you are subscribed to my emails because I will announce the date and topic for our next T.A.N seminar soon. I look forward to seeing all of you. Thank you again very much, Michael. Everybody have a great night.
Great. Thank you so much. I've appreciated it. And we'll be probably seeing you all again real soon. Take care.
I guess we haven't unmuted everybody yet.
Thank you. Good night.
Bye. Thank you.
Thank you.
I guess the host said thank you. I'm going to stay in for a little bit. Thank you. Michael, I think you got muted. Michael, I think you got muted.
Oh, that's okay. Yes. So I'll say my goodbyes and I'll see you all again soon.
Thank you.
Take care. Bye-bye.
Thank you.